The committee's new statement puts us in a stronger position to support a full and timely recovery in employment and average inflation of 2%. Overall financial conditions are supportive. Encouragingly, the housing sector has rebounded strongly from its initial decline, supported by historically low mortgage rates, and consumer spending on goods has held up well, in part reflecting earlier fiscal support. At the same time, the strong pace of improvement in employment in May and June, which was importantly driven by recall hiring out of temporary layoffs, appears to have slowed. And on the inflation front, despite some bounce back in July, inflation remains weaker than pre-crisis, and it's likely to take some time to return closer to target. Looking ahead, the economy continues to face considerable uncertainty associated with COVID-19, and risks are tilted to the downside. The longer COVID-related uncertainty persists, the greater the risk of shuttered businesses and permanent layoffs in some sectors. While the virus remains the most important factor, the magnitude and timing of further fiscal support is a key factor for the outlook. As was true in the first phase of the crisis, fiscal support will remain essential to supporting many families and businesses. With the recovery likely to face COVID-related headwinds for some time, in coming months it will be important for monetary policy to shift from stabilization to accommodation. And as we move to the next phase of monetary policy, we'll be guided by the committee's new goals and strategy statement. It will be important to provide the requisite accommodation to mitigate the shortfall of employment from its maximum and to achieve inflation that averages 2% over time